The timer starts, they've got 2 minutes to go, else the speaker stops when the buzzer blows. Mixing it up with takeaways that are new, 25 topics that'll benefit you.
Well, good morning. Welcome to FocusCFO and Friends 25 and 50 presentation, and I think we'll have some fun and learn a few things this morning here, and appreciate you coming out this morning. I want to thank Sarah Holland for assisting us with our screen AV work here. She's going to help us through this. And then at this point, I'd like to introduce our panelists today. I'm Mitch Willis, and I'm Area President with FocusCFO, and I'm working on spearheading the new business development for Northwestern Pennsylvania region. I have over 30 years of experience in finance and operations, working directly with entrepreneurs. FocusCFO provides CFO-level support to small and medium-sized businesses, becoming a part of your team, whether you need services for a few hours a month or several days a week. Next to me is Tom Hoffman. He's a shareholder at Knox, McLaughlin, Gornell, and Sennett. His practice is concentrated on closely held business planning, business succession planning, implementation and administration of complex estates and trusts, and tax implications of these matters. Knox Law has served businesses, governmental entities, nonprofit organizations, insurance companies, financial institutions, individuals, and families for more than 60 years, and has offices in Erie, Northeast, Pittsburgh, and Jamestown, New York. Next to Tom is Greg Reese. He's a Senior Vice President of Corporate and Institutional Banking at PNC Bank. He has 35 years experience in the banking industry with over 23 years as a commercial relationship manager. PNC Bank is one of the largest financial services companies in the country with over 52,000 employees in more than 40 states and in select regions around the globe. And Debbie Foister, CPA, serves as a senior manager in HBK valuation, litigation, and forensics. Debbie has more than 25 years of accounting and forensic experience in the corporate and public accounting sectors. She leads and manages the Erie office of HBK valuation, litigation, and forensics. HBK is a multidisciplinary financial services firm committed to delivering exceptional client service across a wide range of tax, accounting, audit, business advisory, valuation, financial planning, wealth management, and support services from offices in Pennsylvania, Ohio, New Jersey, New York, and Florida. So a little bit about how our program is today. We have a business owner checkup panel questionnaire, which was available at the table. If you'd like one, we can grab one there off of the table. But it sort of follows how our program will go today, and it has some of the key topics as to what we'll be covering in our presentation. So you can check off as you go along and see where you are if you'd like to do that. As far as how this will work, you see the countdown timer over on the screen over here, and how that works is we have 2 minutes to complete our presentation on the particular topic. And in the event that we're unable to get that done in 2 minutes, well, we'll just have to see what happens. But keeps it fast-paced, keeps it moving, gives us an opportunity to cover a number of topics so that you won't necessarily have all the answers when you leave here, but you'll definitely know what the questions are and which ones you need to get some more information on. Well, with that, I think we're ready to go. Okay, what is the forecast? Well, it's kind of like the weather. In business forecasting, it's the best laid plans. You make your plans. They sometimes end up in a situation where the doesn't go as you plan, and you get an oh crap moment. And that's kind of like it's not so bad. It's just that, especially if you plan for it. So if you know that things can happen and things can go wrong, and you know that there are other alternative paths that can happen, then you know you switch to plan B or plan C. So it's part of the forecasting aspect of developing your plan. So things don't typically go the way that we anticipate them do. At least you can't force them to, but when they don't, you need to have another plan for that. So one of the things that we look at when we come into a company with the CFO aspect is cash forecasting. Is the company doing a 13-week forecast? And if not, that would be one of our priorities that we want to work with and get an understanding of where accounts receivable is, accounts payable, payroll, and debt, and what the demands for that is over the next 13 weeks so that we can be prepared if something changes. The bankers don't like those last-minute cash pleas, and I'm sure we'll hear more about that today. So we have the cash forecast, and then we have the financial plan as well. So how sensitive is your profitability to the unexpected? You should be looking at it periodically. You want to be measuring to your metrics, or measuring to again, have an understanding of where you're currently running as to where you plan to be and maybe where you've been historically. But you also need to update your forecast periodically as things change, and they do change. So you want to make sure that you have an update. Thank you.
So next slide is the bubble world. And I've been blessed to plan 3,800 estates. And most of my clients, probably 95 to 98%, live in that little bubble world, like that little house there, and they don't have any significant problems. I'm often asked, though, when do you do more sophisticated planning? And it's a lot like making the decision of, do I buy insurance on my house? So you look at if your house catches on fire, you cannot go out at that point and buy fire insurance. So the question is, and Mitch mentioned just a minute or two ago about the oh crap moment. Do you plan for the worst and hope for the best, or do you do it the other way around? So the clients that have the tragic events, whether it's a tragic death, tragic illness, are the ones that keep me awake at night. And I generally prefer to plan for the worst and hope for the best. So one excellent way of doing that is through multi-generational planning. I was blessed to have a mentor down in Pittsburgh, Bob Williams, who mentored me on the multi-generational planning, and really brought up the point of planning, and we were primarily planning to save taxes. And if you notice on that slide, you'll see there's income tax and federal estate tax at the bottom. I'm a recovering CPA and self-confessed tax geek. It took a lot of years for me to push the tax planning down to the bottom of that priority list. What we found once we did the multi-generational planning is that the families give you a pat on the back and thank you for saving them a lot of money in taxes. But when bigger issues arise, and those bigger issues are the ones that keep the family awake at night. If the family's awake at night, they're keeping the attorney awake at night. If there's a divorce in the family, if there's a substance abuse problem in the family, if there's a disability, if there's unexpected bankruptcy, how can those issues affect the family? If there's a closely held business involved, how does it affect the closely held business? One of the key elements of the planning is to avoid those issues affecting the family and the business. So you get a much bigger hug when you deal with issues and try to mitigate those issues through the trust planning.
So we'll continue with the theme of the oh crap moments. For typically, those moments occur when I get a phone call from a client that recognizes that they've had fraud on their account, and typically that happens with checks. If you can advance the slide one, Sarah. So what we found is that there's a statistic here that 82% of organizations experienced attempted or actual fraud in 2018, and 70% of organizations responded that checks were the primary target of that fraud. So what the banks have done and what the financial institutions have developed are different tools that help to eliminate the utilization of checks, moving more to electronic payment options. And one of the tools that we use for doing that is ACH card payments are typically two of the vehicles that we recommend. You're using your card first because you can earn cash back, 1%, 1.25% for those kind of payments. ACH is an electronic option seeing more and more companies moving to that. And if you continue to use checks, we offer a service called Payee Positive Pay, where you're sending us your check file before you issue the checks, so that as they come into the bank, they get processed, they get matched up against the check file that you've provided to the bank, and if there are any discrepancies, then the bank sends you an email with the checks that are suspect, and then you make a pay or reject decision, and again, that helps to protect you from those checks getting processed.
Okay, accountants are often labeled as boring. I hope to crack that myth this morning and share some humor with you about the accounting profession. Where do homeless tax preparers live? In a tax shelter. My first topic relates to tax returns, and that's my oh crap moment that everybody's probably experiencing right now with the deadline coming up. We have some tips for you to move the process along. It's a small business checklist. Generally, items that people forget to tell their tax preparer are changes that occurred in the prior year, such as in 2019. The address, the number of locations, the ownership, and new business out of state, especially with the Wayfair decision, and the name. Those are items that you should be telling your tax preparer about if there's changes. General tax documents that we recommend that you provide to your tax preparer are year-end financial statements, payroll documents, documentation of assets purchased or sold, issued 1099 forms to your subcontractors. Another important topic is the record retention guidelines. A lot of people know what they need to keep and what they don't need, but there's a big area of what you should keep but you don't want to keep and keeps you up at night. So a question we receive a lot is how long should specific records be kept? It's not a very good answer, but it depends. Discarding records too early poses a wide range of potential legal and tax problems. Keeping records too long can waste precious space and resources. Records that you should keep, we recommend the records that you prepare or you use for your tax return for the statute plus 1 year. So the statute's 3 years, we recommend you keep your records for 4. Consolidation is key, especially with your retirement statements. You don't need to hold on to your monthly and your quarterly, just hold on to your annual. Exceptions would be when you get married or you get divorced.
Okay, keeping score. We're going to talk about key performance indicators, KPIs. You may have heard the acronym for that, but they're metrics. And the idea here is don't wait till month end to see how you did. We have there's the concept of proactive versus reactive, and we're advocates of the proactive camp. So how do you know how you're doing during the month? Well, if you're waiting till month end, it's a week or 2 or 3 weeks afterwards to see how you performed, and by then it's too late to do anything about it. So what we like to see is develop metrics that are based on operations, revenues, expense indicators. I don't know, maybe 4 to 6 metrics that you can get a sense of how the business is doing during the course of the week, the day, the week, and the month. And you can use units of individual units shipped, or dollars, or hours, or whatever seems to make sense for your business. And it is different for every business. We like to measure daily and weekly. We like to understand the relationship to the historical data and to the forecasts that you have. So where do we think we ought to be based on the customer's expectations for this period, but also, how does that compare to where we were in a previous year or a comparative year is helpful to get that understanding. But again, it's during the course of the month, so that if something's not happening, if we're not hitting forecast, we can do something about it, and we can react. We can be proactive about the situation. We want to publish it to associates concurrently, so the people in the organization know how you're doing, and you want to reward successes and identify failures, not for blame, but just to make sure everybody's on the same path.
The next exhilarating topic, buy-sell agreements. So interesting little story. I had one of my smartest clients, very successful, called up and said, geez, Tom, I was at an event. The business owner is talking about having buy-sell shareholder agreements, all kinds of issues. He said, I don't think I have one. I'm concerned. I really think I should get one. I said, well, you're the sole shareholder in the company, so you should listen hard. I said, I will do one for you if you really want me to, but I'm talking myself out of a fee here. So you're going to have a buy-sell agreement when there's more than one equity owner in an entity, LLC, corporation, whatever it might be. Generally speaking, the buy-sell agreement is going to contemplate who can be an equity owner in that business. Ultimately, it comes down to who are you going to be in business with? Are you in business with your original entrepreneurs? Is it going to be family members? Are there provisions in that buy-sell agreement that are going to control who the ultimate owners are? On the next slide, you'll see typically that there's going to be a general preclusion on the transfer of stock. There typically are written in exceptions. The exceptions may be for family, it may be for other members, it may be there's a supermajority vote that allows for another person to come in as an equity owner in that business. And those are all issues that get addressed in the shareholder agreement. Also, when you're talking about the exceptions, often you will not want to have just the equity owners who's there now, their spouse or their children come in to be an equity owner, because the question would be, are they qualified? Sometimes in shareholder agreements, you'll get into even more detailed issues like, is there a minimum educational level for a future shareholder? Previous work experience. If it is a family member, we often like to see the opportunity for that family member to work in a competing business outside the region. Are the shareholders going to be on the board of directors? Are they board qualified? Can you have shareholders that are investors in the company via the stock, but not on the board of directors? All these things go into determining who's a permitted shareholder and need to be contemplated in the shareholder agreement, unless you're the sole shareholder. I thought I finished.
Bank covenants. It's something that if any of the business owners have negotiated a loan of any size, the topic comes up about bank covenants and what are they, why are they required, and I think that the first place to start with, why bank covenants, why are they required? First and foremost, it's a regulatory issue in terms of banks are required to establish risk profiles for all of the entities that we do business with. And there are measurements, performance measurements, metrics that go into those risk analyses that are based on those financial performance. The covenants typically flow out of some of those measurements that we use, and often we will use those in lieu of a personal guarantee. They are good minimum benchmarks for the business owner, and again, if you're not hitting those minimum benchmarks, you should be more concerned than the bank is. Some typical financial covenants include cash flow leverage, which is funded debt to EBITDA, which is basically your total outstanding debt, funded debt to your cash flow. Operating cash flow, which we call fixed charge coverage, which we like to see at least 1.1 to 1. That includes being able to cover all of your current portion of your debt, your interest expense, your distributions for taxes or taxes if you're a C Corp, and also the ability for the business to generate sufficient cash flow to support your capital expenditure needs. So whatever you're paying out of cash flow for capital expenditures. Typically, it could be a net worth covenant, balance sheet, and then a liquidity, minimum working capital.
Okay, my next topic will discuss the events that trigger a business valuation. When a business owner dies or gives part of their company for tax purposes, business valuation should be prepared. Financial reporting purposes such as a merger and acquisition or stock options, buy-sell agreements as Tom discussed, succession planning, divorce, and if it's a premarital asset, we suggest that you have your business evaluated near the date of marriage, shareholder transactions. There are 6 steps in the valuation process. First, we determine the purpose of the engagement. Then we select the standard of value. We determine the premise of value. We select the appropriate valuation method. We value the entity. Then we value the ownership interest. Step 2 in the process is standard of value. This is very important because the evaluator must be able to defend the standard of value chosen. Case law in your jurisdiction is important. 4 recognized standard of values are fair market value, which is the most common, fair value, which is applied usually in shareholder disputes in a state court, defined, intrinsic value, and investment value. So it's time for another joke. How does Santa's appraiser value his sleigh? Net present value.
Yes. Okay, I'm up here. All right, we want to sell the right products to the right customers. One of the things that we look at once we get into an engagement, we'll see that we take a look at the cash flow and some of the other foundational areas of a company, but as we look at the growth and the health of the organization, we want to understand the profitability by the customer and by the product. You know, is the sales force selling the right things to the right customers? When you look at the customers, are there certain customers that are taking disproportionate time to service? They're maybe high maintenance customers. And you combine that with the possibility that they're buying the products that are maybe low margin, you might have to look at evaluating that customer and seeing if it's really contributing to the overhead enough to warrant them, or to maybe move your efforts over towards other customers that are higher margin, lower maintenance. And when we look at products and services that are being offered, it's the same kind of thing. There's certain products that maybe the company was started on that you're very fond of and you have a lot of attachment to, but they might not be the ones that are making the money for the organization anymore, or warrant putting all that effort into it. And they may want to be de-emphasized in favor of ones that maybe new products and services that have developed over time that are better for the organization. So there's a fair amount of time that we'll spend in looking at that profitability by customer and product. So when you're looking at your market in general, you want to stick to what your strengths are. You want to figure out what differentiates you and build your marketing towards that particular differentiation. And also the other thing important is things change. You want to take a look at it periodically and consider the fact that because things change, you may have to make a change during the course of the year. It's not a one and done look-see type thing.
Buy-sell agreements continued. So most people know that corporations, LLCs, can have perpetual existence. However, their members or shareholders are not perpetual. So ultimately, there's going to be decisions that need to be made with regard to what happens when there's a retirement, a disability, or a death. In considering those various issues, it's important to think about the panel you have today, because when you think about how those impact issues, you've got the financial side from the cash flow perspective. When there's a major change in equity position of a company, you're going to talk about whether that's going to impact your covenants with the bank, and definitely it's going to impact the CPAs and valuation. One of the most egregious issues that clients have is they have a tendency to want to put all of us professionals in compartments and not have them speak together and work together. It's important that a team works together. And that's why Mitch put together this team at the table today. When we're looking at those issues of retirement or disability, it's important to consider that with regard to retirement disability, it's harder to fund those issues. So as a shareholder decides to retire or becomes unfortunately disabled, there needs to be a discussion, preferably in advance, about how to fund the issue of buying the stock back, if that's going to be one of the options in the shareholder agreement. Death is a little more permanent, but also is easier to fund, because most people, if they don't have major issues, can usually get some sort of life insurance to help fund liquidity issues on death. So considering those issues in advance is crucial, and thinking about how those issues impact the other professionals at the table and what they're performing for the company is crucial as well. With regard to valuation that Debbie was speaking of, if you combine the shareholder agreement with the multi-generational planning I mentioned earlier, you can avoid the need to actually deal with the marital issues on getting married. Not to suggest you shouldn't get a valuation, but assets that are held in trust for the junior generation are not subject to equitable division, and therefore do not need to be valued when they become a shareholder company. I'm done. That's close.
At some point in the company's life, there's a likelihood that you'll be in a position where you need to borrow. So I thought that it would be helpful to outline what the banks are looking for when you're coming to the bank and looking for seeking a loan request. At a minimum, we need 3 years worth of CPA prepared financial statements. Again, we do an analysis of those comparative year to year. We're also looking for year-to-date interim statements with prior periods. Again, it gives us the ability to measure same points of time and year over year comparative analyses, and again, see trends that are developing in the business, positive, negative, and to have conversations about. We typically ask for accounts receivable and accounts payable aging reports. Accounts receivable agings, they provide an insight into the industries that the company is serving, specifics about the companies that they're serving, can show us if there are concentrations in both in terms of clients or industries that we might want to talk about. Accounts payable agings provide a window into, is the company, are there cash flow issues because you're maybe riding your payables a little harder. You're not paying in a timely basis. You're using them as a form of liquidity for the company. Details of the transaction, we're looking for you to help us tell the story so that we have a good understanding of what it is that you're looking for the funds for. An idea of the proposed collateral that would be a part of the transaction, and any sales agreements, invoices, or related documentation.
The third step of the valuation process is the premise of business value. The main premises of value are going concern, which is the mostly applied in our valuations, assemblage of assets, orderly disposition, and forced liquidation, which is generally used in the bankruptcy setting. Step 4 of the valuation is the methods that are available and widely used. That's the asset approach, the income approach, and the market approach. The asset approach is primarily an adjusted balance sheet. We're adjusting book value to fair market value. This is usually with the equipment, the real estate, the inventory, and it creates a floor value in most situations. The income approach, there's two main variables: the cash flow, which is the benefit stream to the owner, and the cost of capital, which is the risk associated with achieving the benefit stream. The cash flow methods, capitalization of cash flow, is generally based on historical information. The discounted cash flow is used in situations where the company has a strong history of accurately predicting forecasts. The cost of capital, it's the rate of return required to draw investment in the subject company. It's displayed as a percentage, and it's higher the risk perceived, the higher the required rate of return, which is the lower value of the company.
Okay, let's talk about the monthly close. So here's a little video clip that explains the monthly close.
The first rule of Italian life. What's behind me is not important.
So maybe that's not totally true, but one of the emphases, or the company's emphasis, shouldn't be necessarily what happened last month, but it should be on how the month is progressing on your key performance indicators. But you still need to do a monthly close. And we need to do that because we have to reconcile the accounts every month and match the revenues to the cost and expenses, make sure there's that correlation. We want to generate historical financial reports because we do need to do that for compliance reasons, tax reasons, and costing studies. But it primarily, it's something that we need to do. It's also part of internal control to be sure that it's a review of the cash disbursements and that and cash receipts so that we know that things are being properly recorded and to keep a finger on the pulse of possible fraud in that. But what causes delay in the monthly close? Well, oftentimes there's too much detail in the general ledger. I've worked at companies that had 7,000 accounts in the general ledger and they were trying to do the product costing in the general ledger. Well, that's not where you would typically do it. So we needed to make a change there. Oftentimes companies are striving for perfection with the monthly financial statement, but they really should be considering using estimates. If it doesn't matter, if you're close, if you're within a few percent, and then you correct it the next month or true it up the next month. So it keeps the emphasis on getting information out quickly. And then also lack of accounting systems in that, and maybe use of Excel in that they can enhance their capabilities and make it go faster.
So this slide depicts a Texas shootout. In any company, there should be considered amongst the shareholders prior to the time needed, hopefully at the inception, what is going to be the exit strategy. So the question ultimately is, if you have a 50-50 shareholder situation, what happens if there is a deadlock amongst the equity owners? That deadlock is going to result in the deadlock of the board of directors, and oftentimes can result in very difficult negotiations. If there's an opportunity to deal with that deadlock by requiring or an option of one of the equity owners to offer to buy the other equity owner out, that can sometimes be very helpful. Importantly, in this particular strategy, not only is there an option to buy, but the person who triggers the option to buy doesn't know if they're a buyer or a seller. So in that regard, they will not have an incentive to either lowball the price or to overpay for the company because they won't know if they're a buyer or a seller. That works in 50-50 shareholders, and it's extremely effective. Planning for the worst and considering what might happen, when we include these provisions in shareholder agreements with those circumstances, the clients almost never want to find out who can pull the gun fastest and shoot the most accurate. The more often than not come to us with an agreement, hey, we're not getting along any further, here's what we're going to do, Joe's going to buy Bob out or Sally out, and we're going to move forward on this basis rather than figuring out who's the fastest shooter. In other companies where you have more than 2 shareholders, there still needs to be considered what should happen with regard to a dissatisfied shareholder or the company moving in a direction that all the shareholders aren't happy with. When you have 3, 4, 5 shareholders, it's a little more difficult because you can't just do the Texas shootout. Ultimately, though, you may have a supermajority vote where that would give the option in the company to buy out a disgruntled shareholder. It's tyranny of the majority, but as I've told most of the shareholders, if 3/4 of the shareholders don't want you there, you should want to move on and do something else with your life. Thank you. Applause.
So as I mentioned in the prior slide, collateral is certainly a component of the loan conversation, the loan request conversation. I've been doing this for 35 years. And it's interesting to see how the dynamics have changed and the requirements have changed during that time frame. When I first started, collateral often could be the primary consideration for a loan request. That has changed considerably, during that time frame, particularly again back to the the regulatory scenario and risk analyses, cash flow really is the primary source of repayment, and that is the bank's primary focus, is looking at the ability to repay via cash flow. Collateral is the secondary source of repayment. So that is the order in which that we look at things, the ability to pay via cash flow. Secondarily then, what is the ability to liquidate the collateral. And in looking at that, there are margins that the bank establishes for, and they're pretty much based on what the expected net that the bank would receive in a liquidation scenario. So for example, accounts receivable, we normally collect 75 to 80%. Inventory is 40 to 50%. Equipment, 50 to 80%, again, depending upon the type and age of the equipment. Investments can be 70 to 90%, depending upon, again, the types of investments that are being held. Real estate, more regulated, typically not more than 80%. And many times you'll hear borrowing bases. Those are typically on more leveraged transactions, and they're tied directly to the working capital scenario.
The third approach in a business valuation is the market approach. Generally, it's combined with another approach or used as a sanity check. Seldom is it used 100% as the approach to be relied upon, but there are certain situations where that is applied. There are two methods: the comparable transaction method, which is small private company transactions. The second is guideline public company method, which is large public companies traded transactions. We look at the transactions involving companies considered reasonably comparable to the subject company. It doesn't have to be exact. The key attributes that we look at are the type of business, the size of business, the geographic location, the product diversity, and the level of competition. As an example, if you were looking for a home and you were looking at the listing price, you would not expect a home in the oceanfront home in Naples to be similar in price as a lakefront home in Erie, Pennsylvania. The geography matters in the price. The market approach is usually applied 100% in industries such as the fast food franchises, property and casualty insurance agencies, and grocery stores. Again, geography is important. We had a case in Pittsburgh for a landscaping company, and the opposing expert tried to use landscape companies from California and Florida to compare to Pittsburgh. We also apply valuation discounts when necessary. Discount for lack of control is for minority interests. Discounts for lack of marketability is usually for minority interests, but in certain situations we do apply it for controlling interests. And then in divorce, sometimes we apply the selling and taxes associated with the sale of the subject company.
All right, let's talk about what today's CFO is. Yes, you've come a long way, baby. The titles of CFO, controller, comptroller, treasurer, director of finance, VP finance, all these different titles have a couple of different roles in common with them, whatever the title may be. One role is the tactical role, and that's transactional, historical record keeping, compliance part area. That would be one aspect of one of the roles of those titles. The other one is the strategic, forward-looking analysis, understanding of risk. Both are important. The strategic is dependent on good tactical implementation. So, but they are different roles, and oftentimes people get confused as to who's providing that role or if one role is actually getting done. So the decisions that are based on, that are made on transactional historical information are typically reactive, and it's either damage control or a belief that past performance is indicative of future expectations, and that's not necessarily the case. Decisions that are made on the strategic, proactive area actually they avoid costs and you can gain from opportunities and manage risks. So we like to see the decisions being made on a proactive role. The controller is typically, well, I guess you think of a controller as the historian for the company. So looking at the backward-facing information versus the CFO role, which often gets missed and not done, is the CFOs are key in developing and implementing strategy for the company to achieve its goals. There's a picture on the slide of a big nose, and basically the CFOs are like James Bond who has a license to kill. Well, the CFO has a license to stick their nose in everybody's business, and if they should be questioning everything, and if they're not, then nobody's probably fulfilling that CFO role.
So once the CFO has stuck their nose into everybody else's businesses and decided that there's an appropriate shareholder agreement in place that's going to deal with the eventualities at the company level, they should also stick their nose in, even though it's maybe not the personal part, and say, hey, the shareholders need to make sure their own house is in order, and do the individual shareholders have a succession or business or estate plan for themselves? So it's unfortunate, but if you read the newspaper sometimes, bad things happen to good people. So you basically need what we've referred to as a beer truck plan. What if the beer truck runs over a shareholder? What happens next? Again, we've already addressed that for the shareholder agreement. What about the shareholder's family? So typically we're going to recommend that there be a multi-generational plan with a will that's going to incorporate the goals and wishes of that family and that shareholder for their family. We're going to talk about having a power of attorney, healthcare power of attorney, because most people, actuarially speaking, would more likely become disabled and not be able to deal with those issues rather than die. So there definitely needs to be consideration as to how those things would impact the transaction. Also, the question comes to being addressed is, what happens with regard to stock in the company? Is there going to be an individual who's going to be trustee of a trust for that shareholder, but who votes the stock in the company? So we oftentimes split up or bifurcate the voting of a closely held business interest versus the management of a diversified portfolio. That also needs to be considered at the power of attorney level. So you might have a special business agent that's familiar with issues associated with closely held businesses to deal with those issues. It's important that somebody be appointed to deal with healthcare issues, so that if the individual is unable to make or communicate their own healthcare decision, there's somebody there that can step in their shoes and make sure they have an advocate at the hospital or healthcare institution that they're at.
Ideally, the bank will earn a trusted advisor role to the business by bringing ideas that can help the company grow, create efficiencies, improve employee retention, and protect the owner's wealth. Without that value-added relationship, the business really just becomes a commodity. And again, as I said earlier, with being in the business for a long time, used to be the business owner would come in, say, I need a loan, and the banker was more of an order taker. Today's role, really, the banker should be asking you a whole lot of questions. When you come in and say, I need a loan, the question should be, what for? Understand what the utilization of the proceeds are for, so that maybe you come up with a better structure or an alternative to that need, fulfilling that need. But it's really important that the banker understand your business, understand the industry that you're in, understand your competitors. And again, it's a way of, we operate with a lot of other companies, industries, and hopefully we're bringing you ideas that can share best practices as well. And it is important that we work with your other advisors. We don't work independently. It's important for us to be working with the team that you see here, with the CFO of the company, with your legal advisor, with your CPA, that we're all working towards similar goals. And again, as I said, to be managing the company for the future, understanding what are your transition plans, building your wealth, retaining that wealth are all part of those discussions that we should be having.
My last humor for the day. Did you hear about the fraudulent Irish finance director? He burned his office down trying to cook the books. Embezzlement. It's not a new topic, but we have been hearing more about it in the papers because more companies are going through and charging their employees that steal from them. Embezzlement is generally defined as a theft of assets, money, or property by a person of trust, responsibility over those assets. Now, it doesn't always have to be cash. Sometimes it can be inventory. Accounting embezzlement is the manipulation of accounting records to hide the theft of funds. Now, in this situation, usually it's the controller, the CFO, somebody that has control over the financial statements that can adjust the statements to hide the theft. Skimming is cash removed from the entity before it enters the accounting system. It's off-the-book scheme. It's unrecorded or understated sales. It's more difficult to follow. There's not necessarily a trail. There are ways we can enter through the back door to determine if skimming has occurred. Fraudulent disbursements, that's the most common form of asset misappropriation. It's an on-the-book fraud scheme. An audit trail exists. The areas that usually this occurs in is payroll, accounts payable, or debit cards is a new one recently. There's 4 factors for an embezzlement charge. There has to be a fiduciary relationship, reliance on one party on the other. They had to have acquired the property through the relationship. They've had to take an ownership or given the property to someone else, and the intent, the perpetrator's actions were intentional.
Okay, when do you need a CFO? Well, a small to medium-sized business reaches a certain level of complexity where there's a need for a CFO. And these challenges are typically maybe 5 or 6 areas that become very evident. One is there's cash flow issues. So it might be that the cash is there's a lot of cash flowing and your payroll's getting bigger and you need to be sure that you have money to meet that payroll and you're unsure from week to week, and so you need a cash plan. And so one of the things that you'd want to do is look to implement a 13-week cash flow plan so that you can get an understanding of where you're going to be. Also, lack of timely financials. So you're spending more time on reactive decisions than being proactive. And so there would be a need to develop some of those KPIs that we were talking about. Struggling with growth, a company might just be stagnant there and may say, hey, look, we want to grow our sales, we want to grow our operations, we want to move them to the next level. And so that's where a CFO can help figure out where those areas between customer or product profitability should be getting emphasis. Difficulty in getting loans, the CFO can help build that relationship with the bankers and be prepared for arranging for financing. Basically, when you don't need it, that's when you can get it, rather than when you're scrambling to pull things together. There might be concerns about profitability. Are you selling the right products to the right customers? And then also thinking about transitioning the business, whether it's a succession plan to family members, to the leadership team in a few years. You want to get the company put in a position where it shows the best value, and it takes time to do that. So these challenges require a level of expertise generally learned from years of experience.
So family private equity model, one of my favorite topics, is a method of succession planning that has not been advanced very often by the professionals in the past. It happens more accidentally or organically. But we're looking at trying to give that as an option to business owners rather than just as the classic transition it to your children. If that doesn't work out, then go ahead and sell it. So that the model basically, as you see on the screen there, where you have the children who are the successors to the senior generation, are the equity owners in the business, typically in a trust that are protected from outside issues. They hire an independent board of directors. It may be that some of the children are on the board, depending upon if they're board qualified. The board of directors hires the professional management team, the president, vice president, secretaries, et cetera, and they continue to own the investment in the best damn investment ever. Most of our clients who own closely held businesses appreciate their business, they understand their business, they'd rather invest in that than in the stock market. So it's a natural progression once they begin to understand it. When does that understanding occur? So a lot of business owners view their business as a opportunity for them to go to work hard, generate cash in their business, and it's a cash flow entity. Mitch has been talking about that a lot. But that cash flow really is a return on investment. So the family private equity model really becomes more relevant when the business owner has the epiphany that, hey, if I could sell my company to a private equity company, then why in fact would I want to sell? Why would they want my company? Because it's a great investment, it's a great tool. Why not have the family invest in that business rather than selling it to private equity? So as the next slide indicates, once you take the role of the family private equity model, you have many options. You can build and sell it. So you continue to have that option. You can grow an in-house person to buy it, like the president. You can have family succession, or you can have the private equity model platform, the slide I just indicated.
Bankers don't like surprises. The last thing we want is for you to come when something's blown up. If we have an opportunity to have a discussion before things happen, it's a much better scenario to be able to work through those circumstances and come to more positive resolutions. It's often very hard, as Mitch said earlier, coming to the bank when you've already you've have a severe cash flow issue, you've not done timely reporting, and you're discovering that there's an issue, and your banker doesn't know what's going on in the business because you've not had that discussion or not brought them up to speed. As I mentioned earlier, the model's changed in terms of your bankers should be talking to you on a regular basis. So hopefully, that's not the issue. You're not bringing a big surprise to your banker, that you're having proactive discussions. You're providing timely interim information, yearly financial statements that allow you to have conversations about what's happening with the business, new developments, both positive and negative, so that you have an understanding of what are the best avenues for resolving the circumstance. Allows for the banker to provide or recommend changes, potentially changes to your loan structures, your covenant structures. Again, if we understand what's happening with the business, many times there are one-time events that occur, loss of a client, particular vendor that may have a period impact. As long as we understand what's going on, we can work through that. And again, the better your banker understands your company, the better he or she can advocate on behalf of your business to implement the best solution in any circumstance.
Previously, I discussed embezzlement and how it can happen in your company. We'd like to give you some tips on some controls, internal and external, to help you protect your company. Some of the controls you may already have in place, some might not be applicable, but implementing controls is best to safeguard your assets. So what can you do to reduce the risk associated with your company becoming a victim of embezzlement? The internal controls that we suggest are checks and balances. I just worked on a case recently where the guy had a lot of checks and balances in place, but he wasn't checking. When he would sign a check, he would not record the last check number and then compare it to the next check number. So although he was comparing the invoices and making sure everything was accurate, checking it 2 or 3 times, the bookkeeper was able to process a check at the beginning or the ending of the accounts payable cycle and was able to pay her own credit card bills. Segregation of duties is important, mandatory vacation. accountability, monthly reporting, blank checks stored in a secured location with limited access, well-defined company manuals, employee reimbursement policies, etc., security camera, and strong inventory tracking program. External controls, change the timing of an annual audit or a review if it's applicable. Theft insurance or bonding is very important. When I work on cases, that's one of the first things I ask. Lots of times they'll pay for my service, plus they'll pay for the reimbursement. Third-party payroll service, since payroll is one of the areas that's easily seems to be manipulated. Most importantly, have the cleared checks included with the bank statements. That would stop a lot of the issues with someone typing a check out to themselves and then going into the accounting program and changing the name.
Can you say that last part again?
To have cleared checks with your bank statements, because a lot of the cases that I'm running into, the bookkeeper will print the check out in their own name. They'll go back into the accounting system and put it under a vendor's name that you're used to. So if you are with a supplier all the time, say ABC Company, and you're looking at your financial statements or you're looking at approving payments, ABC Company, you buy supplies all the time. You may not notice the money that's being diverted, and it's not really to ABC Company. But if you look at the bank statements and you scan and you see a check made out to your bookkeeper, you know, it sends a red flag, then you go back and you look and you see that it's coded to supplies, then you know that you have an issue.
Okay, where is the founder or the entrepreneur best utilized in an organization? So we're talking about the president and the CEO here. So where are you spending your time? Typically, the founder, entrepreneur of the organizations start a business because they're really good at operations and making a product, or they're really good at sales. It's not typically that they're really get excited about doing the accounting and finance functions, unless that's the nature of their business. So if you are making it and you're part into the operations, you want to be spending your time on research and development and inventory and purchasing, because that's typically where the value is, that you have that understanding and can be most important. Or in the marketing area, on the sales side, the sales effort, getting out, meeting with the customers, developing the marketing plan, order processing, fulfillment, expediting, and that's where we would see the founders most typically should be spending their time on that. When you look at the finance function, founders just out of necessity will end up doing that because there's either nobody else to do it, especially at the beginning of a startup organization, or they want to make sure they know where the cash is flowing. But when companies get to a certain size, they just can't be all things to all people and know about everything that's going on. So at that point, it makes sense to bring in making sure that the controller type functionality, the reactive or the transactional reporting is getting done, but then also look at bringing in someone to look at the strategic finance area and make sure that that's getting done, because that would typically get overlooked just because they don't know about that. So we want to thank you very much for coming to our session today here. We appreciate you spending the morning with us here. We went over 25 tidbits of information in 50 minutes. And if you have continued questions, feel free to reach out to any one of the panelists. Their contact information is on the questionnaire that we have here. And do take a look at the bottom of the questionnaire when we were talking about where does founders spend their time. There's a little chart that you can go through and indicate where you're most valuable and where what you like to do the best, and then what you're currently doing. And that's a reconciliation process that you might want to go through that exercise and see where you want to spend your time.
The timer starts, they've got 2 minutes to go, else the speaker stops when the buzzer blows. Mixing it up with takeaways that are new. 25 topics that'll benefit you.